Well, thanks for joining today, James. Excited to get your thoughts on 2026. So, from your seat on the debt side, how would you describe the market right now?
As a whole, I'd say, it continues to be pretty active. Excuse me. The first half of the year was definitely quieter than the second half of 2025, both in terms of what lenders were seeing in terms of their own pipeline and deals that they were getting comfortable with. But on top of that, companies looking for capital. So around mid-year, it seemed like both sides of the equation got pretty busy. We saw an uptick in companies, either that were starting to look for capital or, were exploring earlier in the year and they decided to actively pursue. And we also saw lenders getting more comfortable with, the global macro economic environment, whatever terminology you want to use, to be able to start getting more aggressive in the deals that they were doing. So with companies continuing to, I always describe them as like, doing fine. Most companies we talk to, they're growing enough. They're not, hyper growth. They're generally, on a clear path to break even if they're not at break even point already from a P&L perspective. And they're just looking for capital to put their foot on the gas a little bit without having to go down an equity route, or they're looking to accelerate a little bit into an exit that, I think once again, as we have for the past few years, everyone's kind of hopeful that 26 will start to see a bigger exit activity than we have the past few years.
Yeah, definitely. And I guess just to follow up to that, what would be some of the misconceptions that you've heard about the current lending environment?
I would say, we're still hearing it, but less so. It's a lot. A couple of years ago, it was a lot of, well, I'm not raising equity. I'm not going to be able to raise debt. And, it took a lot of education in the market. And, we did what we could with companies we talked to, but I think as a whole, the lenders did a good job of educating the market and their borrowers. And I think investors started getting involved as well in these different capital options for companies. But I would say that, the big misconceptions we still hear are, I'm not raising equity. I would so I don't know if that's an option. And then the other side of it, I would say is, debt can be difficult. That has its pros and cons, I guess. So, like everything, the you have to repay the money that's invested. A lot of companies, I think, assume that because it's debt, it is more toxic to the company, which is just not the case. It's simply less dilutive. So lenders, just like investors, want to work with the company to make sure that their capital in the business grows at a healthy rate. They're not like I think what a lot of people are afraid of, where they just decide, okay, you miss a payment, we're going to come take everything. That's not how lenders operate. So I think that those are probably the two biggest misconceptions that we end up having to address with a lot of companies, whether it's management or the board and investors, when it comes to processes that we're running.
Okay, awesome. That's helpful. Um, Continuing on kind of that lender behavior and credit appetite, what has changed over the last 6 to 12 months in terms of risk and their appetite for that?
I would say, honestly, we're seeing a bit of a bifurcation in that we're seeing lenders go really opposite ends of the spectrum. And it shows in how active that they actually are and how quickly they're moving on things. So some lenders have started really retreating. Some lenders that we would do several deals a year with, they themselves might be doing 15 to 20 deals a year. I'm hearing that they're doing less than 10 now, and they're, getting really selective in what they're doing. But the challenge is they're not necessarily bringing down their cost of capital. So the higher quality deal, the more competition you're going to have, and more likely you are to be outbid. So
Mhm.
we're seeing lenders fall into that category, while simultaneously a good chunk of lenders are getting more aggressive. With more groups getting more conservative, there are pockets of lenders in different sectors and size ranges that are seeing the opportunity to get really aggressive on deals. Now, they may get an enhanced premium on their capital as a result, but it really has been split down the middle, it appears, over the past 6 to 12 months. Out of maybe every 10 conversations I had with lenders in the tail end of last year, five of them would say that they were had a very modest year and were very conservative. The other five said it was the busiest year they've ever had. So I expect that to continue over the next 6 months, just until some type of refinancing or equity or exit market starts to pick up some traction.
Yeah. Okay. Well, earlier in the conversation, you said, we typically deal with companies that are doing fine. What are some of those attributes of companies that would make a deal attractive to lenders?
So when I just want to clarify, when I say most of our clients are doing fine, what I mean is, slow to modest growth year over year, generally steady metrics and margins, path to profitability. Everything's okay. You look at it, no one's going to get super, super excited most of the time to throw money at it. But most of the time, the lenders aren't going to have to worry in reality that they're going to lose money on it. It's not a true like high growth burn and make a ton of money or lose a bunch. We have a healthy pool of clients, honestly, that lenders have described as perfectly boring transactions and a safe place to put capital, which is great. I would say what does make them attractive a lot of the time is we're seeing more and more companies with truly established business models and market presence. So, they've reached, high, eight figures, if not nine-figure revenue. They have achieved profitability, some of them material profitability, but might have some metric concerns, or they're steady, just kind of moving along. They have a long-term horizon and they're managing cash very effectively, but that might be at the expense of high growth. So I think what makes them attractive to a lot of lenders is most of the companies now, it's not I need money to keep the lights on. It is truly, I need money to continue growing and I want to extend my runway a bit as a result. So I have a healthier burn. And then on the other side, I think what makes it attractive for lenders, primarily in the private credit space, is banks continue to be a little more modest in the types of deals and how many deals they're doing. So private credit is really stepping in, and what's making it attractive for them is banks are more friendly in working with the private credit guys, whether it's refinancing from a bank into private credit or some type of split lien or junior senior situation. So it's definitely, on the lender side, it's definitely moved toward their favor in a lot of ways and being able to structure terms that are attractive for both parties.
Yeah, that's helpful. I think too, what would also be helpful is just if you're a founder, and maybe describing the opportunity to have kind of that assessment that we do. So from start to finish, before we start a process, we're going through and testing that to see if there's appetite between 5 to 10 lenders. So can you talk more about that specifically?
About how we start the process there.
Yeah.
Yeah. So, what we like to do before we engage any company is do an initial preview with a prospective lending pool. So it's not a formal credit review. When we come back, we're not getting term sheets by any means. But, as long as we have the information from the company and they haven't withheld material information, we have a pretty good picture of as to who we would go to. And what we're able to do is call up the lenders that we think would be a fit. And, it is designed to be a thumbs up, thumbs down type of conversation, generally about 5 minutes or so. And it really is I'm evaluating this company. This is where they're at. This is what they're looking for. Sometimes we'll talk through situations like, hey, that their runway's a little tight, but, an extra 5 million gets them there comfortably and they're doing X amount of revenue. It could be, a difficult refinancing situation. It could be an acquisition, whatever it might be. We want to just give a general overview of the company to the lender, and we just want to know their feedback. Yeah, I think that could be a good fit, or you know what, that's going to be really tough. It might not work for us. And what we're able to do as a result is get some real time market feedback from those handful of lenders to the company. Now, if we only get one interested party out of 5 to 7 preview conversations, we're very upfront about it. We've had companies say, you know what, that's not enough for me to move forward, which is perfectly fine. And then we've had companies say, you know what, let's give it a shot. One's better than none. So it really, I think, allows us to go into it with transparency and eyes wide open and everything. And the goal is to not waste our time or the client's time and set unrealistic expectations and try to get someone engaged to then start the homework. And you never want to find out right away that, ooh, I shouldn't have taken this on. I completely misjudged this.
Right. Yeah, we're not in the business of wasting people's time, including our
Yeah.
own. Um, okay. Well, a couple more questions for you and then we can wrap up. But in your view, as you're looking at these companies and they're getting some initial information over, we talk a lot about lender readiness at Fifth Line. And so, what are some of the key pillars of being lender ready?
So, have your financial reporting in order. There's only so much we can do from the outside. Have your systems up to speed, have your books ready to issue reports. Don't send something that you think immediately might change in 30 days from a projection standpoint. We've had companies send out a projection and then we start the process and, they're like, hey, I have an updated model and it's a grossly negative comparison. And now we got to figure out how to walk back everything we sent out. So I think that's probably the big one is just make sure your financials are ready to share. The other thing is make sure everyone's on the same page. You don't want to start a process and say, we're comfortable looking for, $5 million in a term loan. And it turns out the board had no idea. Maybe even the CEO in some cases wasn't aware. And it's just kind of the CFO doing a fishing expedition to come back with some options, and then it ends up wasting everyone's time. And it's difficult to, maybe they want to do something in 6 months. It's difficult to keep the lender on board. And on top of that, most companies do not perform according to their projections. So, it's difficult to re-engage lenders down the road if you don't perform. So more than anything, to the point of what you call it, lender readiness, just when you're ready to start a process, just have your stuff in order. We send a checklist and even provide templates and examples when needed of information we need, from financials to projections, data reports. If you don't have that stuff ready to go, you don't want to start with half or even 80% of the information. You really want all of it, because then it mitigates any follow-up requests and one more item type of trickling in, which can really prolong the process. And the longer you take to get stuff over as lenders request it, the more it raises red flags for them that maybe the financial infrastructure isn't quite there.
Right. Yeah, time kills all deals, as they say. Okay, last one. Not to give too much away, but what are you looking forward to building or focusing on this year in 26?
Yeah, so as a whole, we're seeing improved client profiles and increasing size of client needs. So, a couple of years ago, our average deal size was less than 7 million, and now I think after uh, the end of this month, looking backward over the past 12 months, will be closer to 14 or 15 million average deal size. So we're definitely seeing a larger average capital need while also being able to continue to serve the smaller clientele looking for that $1 to $5 million check size that more groups, especially in our space, are continuing to move on from effectively. So, and we've been able to do it with a lot of the technology and the infrastructure that we've built out. What we're excited about is, we're launching this year a revised deal portal for us to engage with lenders on the types of opportunities we're working on. We also have our new partner portal. So that's been a big driver of growth for us in the past 12 months, is partners working with us and integrating our services into their services and their offering to companies. And we're able now to start implementing a more productized approach. So it'll just create a better client experience and experience for the partners as well. So it's less cumbersome for them. So between those two things, and everything else we're working on, we're excited about, how much faster we can grow this year. We do have a new deal workflow platform that we are putting the final external touches on over the next couple of months, that we've been using for a while internally. And, the goal is we'll be able to, essentially do more with less, be able to be that much quicker and that much more efficient with clients from the process, from beginning to end, without having to increase the headcount and create more confusion. So there's a lot that we're working on, and we're excited, especially for the tail end of this quarter, to start releasing a lot of those product updates.
Awesome. Yeah, sounds like it's going to be a great and very busy year, which is
Yep.
always good to hear.